Welcome everyone to a session on income tax training. In this video, we'll walk you through the fundamentals of the income tax system. We'll begin with an overview of income tax and explore the various heads of income that shape the Indian tax structure. Let's get started. Let's say you earn money whether through your salary, running a business, or even investing. The government asks for a share of that income to fund things like schools, hospitals, roads, basically to keep the country running. That's where the income tax come in. Now, not everyone pays the same amount. If you earn more, you will have to pay more. But if your earnings are on the lower side, the government may cut you some stack through rebates or tax benefits. You can even invest in certain schemes that help lower your taxable income. Every year during the union budget, the government might tweak the tax rules. Sometimes it's good news, sometimes it's, well, just news. So, in a nutshell, income tax is how we contribute to building the nation, but smart planning can make it easier on your finances. Now, let's define income. So, as per Section 2, subsection 24 of the Income Tax Act, the definition of income is inclusive, not exhaustive. Generally, income refers to the periodic returns from the sources like business, property, work, or investments. But it doesn't just mean money, it includes benefits and perquisites too. So, even if you use a property yourself and save on rent, that saving could be considered income. Where does your income come from? To figure out how much tax you owe, the government breaks down your earning into 5 neat categories. It's like organizing your closet. Each section tells a different story about where's your money coming from. The first comes income from salary. Your regular paycheck, bonuses, allowances. Basically what your employer pays you for your time and skills. The second is income from house property. Do you have a house or apartment you're renting out? The rent you earn counts here, even if just one cozy flat. The third comes income from business or profession. Freelancers, shop owners, consultants. These ones are for folks running their own gig or profession. It covers profits, fees, and revenue. The next comes income from capital gains. If you sold something valuable like shares, land, or even gold and made a profit, this head keeps track of that boost. The last is income from other sources. Everything that doesn't fit neatly into the boxes above, like lottery wins, interest from saving accounts, dividends, the miscellaneous drawer of your financial life. Whether it's your job, your rental property, your investment, or your side hustle, each source has its own tax rules. Knowing where each type fits helps you plan smartly and stay sorted. When we pay income tax, we are basically contributing to the growth and maintenance of a country. This money helps the government build and repair roads, support schools and hospitals, run public transport, and fund social programs. It also used to pay government employees like teachers, police officers, and civil servants who work to keep things functioning. In simpler terms, tax is not a penalty but a shared responsibility. It's how each of us pitches in to ensure that nation has the resources it needs to thrive. Now let's talk about financial year, assessment year, and calendar year. Imagine you're watching a show and tracking seasons. The government does same thing like track incomes, taxes, and reporting. But they break the year into 3 types. The first is financial year. This is the earning year. It's a 12-month window from 1st April to 31st March when you are earning income, making investments, and tracking expenses. Think of it as the season when all the actions happen. The next comes the assessment year. This comes after the financial year. It's when the tax department steps in to review your earnings and calculate how much you owe. For example, if you earned income during the financial year 25-26, the government assesses it in assessment year 26-27. The last is calendar year. This one is the easiest, is the regular January to December year, which we use for birthdays, holidays, and New Year resolutions. Not specifically tied to taxes, but good to know the difference. Why all does this matter? When you're filling out the tax form or planning your finances, knowing which year they are talking about helps you stay ahead of deadlines and avoid mix ups. The financial year is when all the money making action happens. Between April 1st to 31st March, you are working, investing, maybe renting out property. Basically, this is the year your income flows in. Then comes the assessment year. It's the year after financial year when you sit down and file your tax return based on your income you made last year. So if you made income between the April 2025 to March 2026, which is financial year 2025 to 2026, you'll report it in assessment year 2026 to 27. It's kind of you like spend a year cooking and the next year serving the dish to the tax. You see, income tax isn't it just about crunching numbers. It's about timing. Timing defines everything. Let's talk about two key players in this timeline, the previous year and the assessment year. Imagine the financial year as a stage. The curtain rises on 1st April and it closes on 31st March. This 12-month window is your previous year, that when you earn income, make investment, and go about your financial life. Now, once the curtain falls, a new act begins. Enter the assessment year, which follows the immediately after. It's the phase when the government steps in to review what you have earned and how you have earned it, and what are your tax liabilities. So, income earned from 1st April 2025 to 31st March 2026 will be assessed in the year 2026 to 27. It's a simple rhythm, really. Earn now, assess next year. And once you tune into this flow, tax season feels a little less intimidating and a more logical. So imagine you're laying out all the money you have earned in a year, your salary, rent from your property, profits from freelancing, gains from selling shares, even the interest from your saving accounts. Once you have gathered, you're looking at your gross total income. It's like your financial grand total before any tax benefits kick in. Now, the tax system lets you subtract certain investments and expenses like payments towards insurance, retirement plans, medical expenses, and charitable donations. These fall under various deductions like ATC, ATD, and others. After you apply these, the final figure you are left with is called your total income. This is the amount the tax department uses to calculate how much tax you owe. So, in simple terms, total income is equal to the gross total income minus deductions. Now we will move towards the explanation of income tax table under the old tax regime for the financial year 2025-26, which means assessment year 2026 to 27. It's like sorting people into a bucket based on age and income. Each bucket will own tax rates. If you are under 60 years old, on up to 2.5 lakh, no tax. Between 2.5 to 5 lakh, you pay 5%. 5 to 10 lakh, you tax. The tax jumps to 20%. Above 10 lakh, you are in the 30% zone. But if you are between 60 to 30, which is senior citizen age, up to 3 lakhs, there is no tax. Up 3 to 5 lakhs, 5%. 5 to 10 lakhs, 20%, and over 10 lakh, 30%. If you are 30, if you are 80 or older, super senior, which is up to 5 lakhs, tax free zone, 5 to 10 lakh, 20%, and above 10 lakh is 30%. The government gives some age benefits, so senior and super senior citizens get higher exemption limit before tax kicks in. It's a way to ease financial pressure on older individuals. Income tax slab where new regime is up. Let's say your income is like filling up different jars. Each one gets a tax a little more than the last. Here's how it stack up. If you earn up to 4 lakh, you are in clear, no tax at all. On between 4 lakh to 8 lakh, you just pay 5% on that portion. From 8 lakh to 12 lakh, it's 10%. Hit 12 lakh to 16 lakh, the slab asks for 15%. Between 16 lakh and 20 lakh, the rate climbs to 20%. From 20 lakh to 24 lakh, you're taxed at 25%. And if your income tax goes above 24 lakh, you are in the top slab, that is 30% tax on that portion. You are not taxed on the full amount at one rate. It's a slab by slab system. So each slice of your income tax get taxed at the rate matching the chart, not all at once. Once your income crosses certain threshold, the government says, "Hey, you are earning a quite a bit. Let's add a little extra." That little extra is called surcharge. It's a percentage added on top of your regular income tax based on how much you earn. On up to 50 lakhs, no extra surcharge. 50 lakhs to 1 crore, you pay an extra 10% on the top. 1 crore to 2 crore, it gets up to 15%. 2 crore to 5 crore, it jumps to 25%. Above 5 crore, old tax makes it 37%, whereas the new tax regime caps it at 25% for fairness and simplicity. So basically, higher your income, the bigger the surcharge, especially under the old regime. And what's this health and education says? No matter your income level, everyone pays an extra 4% on their total tax, including surcharge. It's earmarked for improving healthcare and education in the country, a way for everyone to chip in for national well being. In short, surcharge is equals to luxury tax for high earners. Cess is everyone's contribution to better India. Every year, people cross their fingers hoping the union budget will ease their tax burden, and the financial minister shook things up by introducing a simple, cleaner way to file taxes called the new regime. Instead of diving deep into deductions, consulting experts, or collecting a mountain of investment proofs, the new regime says, let's keep it easy, lower tax rate but no deduction or rebates. It's like ordering the basic thali, no sides, just the essential served fast. But hey, not everyone wants simple, so folks prefers the old regime, where you can reduce your taxable income through exemptions like LIC premiums, home loan interest, or tuition fees. Sure, the tax rate are a bit higher, but with good planning, you can end up paying less. So what's the catch? You now get to choose. If you want fewer calculations and quick filing, go for the new regime. But if you have old investments and want to use deductions to shrink your tax bill, stick with old regime. Let's say you're choosing between two salad bars. The old regime with all the toppings, deductions, exemptions, benefits clear. It's perfect for someone who loves to plan taxes smartly by claiming things like HRA, LTA, Section 80 deduction, and home loan. The new regime is more likely a ready made bowl, fewer options, but it's simpler and faster. You get lower tax rates, but most of the Section 10 exemptions says you can still claim benefits like gratuity, leave encashment, retention compensation, and voluntary retirement under both regimes. But perks like allowance and house rent allowance and educational hostel uniform allowances are only allowed in old regime. According to Section 16 deduction, that handy standard deduction and professional tax relief, only available under the old regime. The new tax regime says nope except for standard deduction. Chapter 6A deductions. These includes your insurance premiums, medical expenses, student loan interest, donations, saving account interest, and so on. All of these are allowed under the old regime and not allowed under the new regime, except one, employer's contribution to NSP, which is under Section 80 CCD, subsection 2. That one works in both. According to Section 24B, housing loan interest. If your property is self occupied, the interest paid on home loan can be claimed only under the old regime. But if it's rented out, you can claim that interest under both regime. In short, if you love using deductions to shrink your tax bill, go for the old regime. If you prefer less paperwork and flat rates, the new regime might suit you better. That wraps up our introduction to fundamentals of the Indian income tax system. In part 2, we'll take a closer look at income from salary, including exempt allowances, professional, and the key provisions under Section 16. Stay tuned for more clarity and insights into how your earnings are taxed.